Fund managers, equity analysts, and even authors have always tried to show investing as a very complicated subject. I think they do this to sell more books or to get more investments into their funds. But once in a while, a book comes along which has a very uncomplicated title. Like this one by William O'Neill, whose title reads, How to Make Money in Stocks. I've read this book a couple of times, and although it's known more for the CANSLIM method, there's a lot more we can learn from this book, and in this video I shall take you through some of the key messages. Now, just to set the expectations right, I shall be broadly explaining the CANSLIM system in this video, but very soon I'll also have a dedicated and detailed video on CANSLIM where we look at specific Indian stocks, how to use it along with a screener. We'll examine small case, and I'll also present a view on whether CANSLIM works in India or not. If you like this video, then do give it a thumbs up, and if you want me to do more of these book reviews, then do let me know in the comment section below. Let's begin. The book How to Make Money from Stocks was published in the year 2009, and foundationally it examines the best performing stocks of the last 125 years. Now, like any typical investing book, it looks at all these years of data, it pulls out a few characteristics that a potentially winning stock is likely to have, but in my view, this book does a lot more. You see, the author William O'Neill started as a retail broker and was one of the first people to put charts on a computer. And it's this orientation that stuck with him through the years, which is why he spends so much time in this book discussing things like how to interpret charts, when is the right time to buy, when is not the right time to buy, when is the right time to sell, and stuff like that. Essentially, O'Neill wants to give us the best of both worlds. A first layer that helps us pick some fundamentally strong companies, and then there's a second layer, the technical part, that indicates when these stocks are likely to make their massive move upwards or when they are likely to lose favor. So the CANSLIM system was developed by William O'Neill in the 1950s and is one of the most studied investment methodologies the world over. In fact, the word CANSLIM is an acronym for a 7-step process or a set of 7 rules that helps an investor identify quality and potentially high growth stocks at an early stage. The first letter C stands for current quarterly earnings per share. It's the characteristic that stood out the most amongst winning stocks, and one should look for companies whose quarterly earnings have increased sharply on an year-on-year basis. How much increase are we looking for? Well, higher is better, but something over 25% will be a really nice number to work with. And it's even better if this growth was accelerating and if there was also a similar increase in the sales number. For example, these are the sales and EPS numbers for Coromandel International Limited for the year 2021 and 2022. So when we examine Q1 of 2022 with Q1 of 2021, we see a 50% growth in sales and an EPS growth of 86%. A similar upward pattern shows up in Q2, Q3 and 4, which gives this company a tick, at least when it comes to the letter C within the CANSLIM framework. Next up is the letter A, which stands for annual earnings. Now, to ensure that the growth in the last 3 quarters isn't a fluke, one has to also examine the EPS growth of the last 3 years. As a metric, we want this to average at least 25% a year, and extending it to Coromandel International, the company comes close with an average EPS CAGR of 24%. Of course, it would have been better if the company had 25% plus in all 3 years, but it's okay to give some leeway on account of cyclicity as long as the volume is supporting that growth. Then comes the letter N, which stands for new, and it means new products, new services, and new management. The point William O'Neill wants to emphasize is that it takes something new to produce any kind of great advancement in a stock. This can be in the form of an innovative product or the creation of a new market, a massive change in government policies, a new technology, a new CEO, etc. O'Neill's studies show that 95% of the superstar stocks in the last century had some or the other newness factor that helped them reach massive heights. For example, a stock like Reliance Industries was going nowhere for many years, but the introduction of Jio acted as a catalyst, and since then the share price is up by at least 400%. So the idea here is to identify companies that are at the forefront of industry trends, which can be done by examining a company's track record of introducing new products and services, their R&D efforts, patent filings, and of course their schedule of product releases. Next, we have the letter S that stands for supply and demand, and I'm referring to the supply and demand of shares here. So O'Neill says investors should look for stock which have fewer shares outstanding, as it means the supply is restricted and having a share buyback program or a top management with some equity interests are useful indicators. Now, demand and supply can be looked at from a technical angle as well. And per the CANSLIM method, the ideal buying point is when there is a breakout from previous levels of resistance. To this effect, O'Neill talks about patterns like the cup and handle, and although I am a beginner to technical analysis, it's not difficult to see that there is a higher demand for shares at that point, and it's probably the institutional investors who are accumulating it. L stands for leaders or laggards, and the simple rule is to buy leaders and not laggards. From a task perspective, always look to invest in the number 1, number 2, or at max the number 3 company from a strong and leading industry group. Understandably, these would be stocks which have the highest relative strength, good market share, increasing earnings per share, strong sales growth, etc. So relative strength is a new word here, and this term refers to a stock's price performance compared to the broader market or its industry peers. For example, here's a list of 30 IT stocks which have a market cap of over 5,000 crores. So let's say this is one homogeneous group. Now, on a one-year basis, we see that KPIT Technologies has had the highest price appreciation. So this stock gets the highest RS, the highest relative strength value of 99. And as we go down this list, the RS value keeps reducing. So per the CANSLIM method, we are keen on companies which have a relative value of at least 80, which effectively means these 6 stocks here have outperformed 80% of all other stocks within that industry or market group. The idea here is to distinguish the leaders from the laggards and to identify those stocks that are trending up, which again makes this section a combination of fundamentals and technicals. The letter I stands for institutional sponsorship. As you might have guessed, we are talking about mutual funds, pension funds, high net worth individuals, insurance companies, etc., who anyways account for a lion's share of the market activity. Now, as a principle, any recent increase in the level of institutional shareholding is generally viewed as a positive factor, and given the size of these deals, it's very easy to spot them by examining the volume charts. What's also true is that it takes these funds weeks, often months, to build their positions, and that serves as an excellent opportunity for the retail investor to enter that stock at an early stage. And finally, there is the letter M that means market direction. Okay, so look at it this way. You can be dead right, 100% accurate about all the previous 6 factors we have studied so far. But if you're wrong about the market direction, then there is a high probability that you will lose money, and you will lose a lot of money in most cases. Now, the study done by William O'Neill and his team shows that 3 out of every 4 stocks follow the direction or trend of the general market. As a simple rule, what it means is that you should buy stocks only when the broader market, like the Nifty 50, is going up, and likewise you should not buy stocks if the market is trending down. In fact, the book has a lot to offer with regards to market direction, but here are some key highlights from this chapter. Okay, so firstly, and what has been observed in a bear market is that stocks usually open strong, but then they have a weak closing, and the exact opposite happens in case of a bull market, which effectively means as an investor, it's important to analyze the price movements, the chart patterns, and definitely the volumes to gauge the health of the stock markets. Actually, when it comes to volumes, O'Neill suggests that investors should look out for a pattern which shows an increase in volumes along with an increase in the share price. This scenario indicates a strong buying interest and therefore a potentially positive market direction for the stock or the index. This is where the book introduces us to the concept of distribution days as a measure of selling pressure by big institutions. So a distribution day is when an index, let's say the Nifty 50, loses more than 0.2% of its value on a single day, with the volumes being higher than that of the previous session. When something like this happens, it generally means the big institutional investors are exiting the market and are reducing their positions. Now, if this happens once or twice, it's not a problem. But if there are successive distribution days, then it means a weakening of the market and the investor should be prepared to reduce his or her positions. In fact, O'Neill mentions it in the book or maybe in a video that a bull market usually comes to an end when there's been 4 or 5 days of distribution over a span of 4 to 5 weeks. It's an interesting way to look at things, and the book goes on to describe a few more scenarios around distribution days, including its expiry, some indicators of market bottoms, the importance of moving averages, etc., which makes this book a must read for every investor. So to quickly recap, the CANSLIM method provides a systematic framework for identifying high growth stocks. It uses fundamental and technical analysis which logically improves our chances of investing success. We broadly went through the 7 steps or 7 investing rules that make up the strategy, and we also made some notable observations on market direction. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released and also share with you some investing strategies, tips and stories that I continually post in the community section. So William O'Neill comes from a trading background, and it's not surprising that his book is splattered with tons of charts. Now, one way of looking at this is who doesn't use charts or some variant of it. Doctors ask for an ECG. Scientists would study patterns, charts and models to predict the weather, and even politicians are known to study charts and other statistics when deciding their campaign strategies. The same holds true for investing, and between these two variables, the price of the stock and the volume, there is a ton of information and signals that are available to us. And while the book dedicates many pages to charting, I think there are 3 patterns that are amongst O'Neill's favorites: the cup and handle, the double bottom and the flat base. In this video, we'll be discussing the cup and handle, and without getting too technical, no pun intended, here's how this looks like. So here's the cup and here's the handle. We start from the left, and there should be a prior uptrend of at least 30% so that we have some idea on how much the stock has risen previously. Then comes the depth of the base, which is measured from the peak on the left side to the lowest point of the cup. This depth should typically be between 15 and 30%, although in severe bear markets, this can be as high as 50% as well. The third element is the base length, and the minimum we are looking for is 7 weeks. Not 6, not 5, but 7 weeks, because as per O'Neill, a shorter base of say 5 weeks is not enough time for the stock to consolidate the prior gains, which consequently increases the chance of failure. The fourth element is the handle, and as you can see here, we are looking for a depth of 10, maybe 12%. So a handle is nothing but a mild pullback, or how do I put it? It's that moment where there is a shakeout and the weaker investors who aren't committed to holding the stock over the long term, well, these guys are looking for the exit, and this typically lasts for about 2 to 4 weeks. It's also important to observe the volume during this period, and ideally this should not be high, because if the volumes are high, then it probably means a serious sell-off and we don't want to be caught on the wrong foot. But the best case scenario is the formation of a nice, small, smooth, low volume handle here. Alright, next up is the ideal buy point, and this is normally just above the peak of the handle. For instance, if the peak of the handle is say 50 rupees, the buying should start from 50 rupees 10 paise, and the buying range would go up to 5% above the ideal buy point, which comes to 52 rupees and 60 paise. But for the best results, O'Neill recommends you buy as close to the ideal buy point as possible, and if you're not able to watch the markets the entire day, then do set up some conditional orders ahead of time. The 6th and final step happens on the breakout day, that is the day a stock goes past its ideal buy point. Now what's important here is that the volume on breakout day should be at least 40 to 50% higher than the normally traded volume. A situation like this indicates strong institutional buying, and it's not uncommon to see volume spikes of 100%, 200, 500, even a 1000% jump. It's a definite sign that there are institutions at work here and that they have started to notice the stock. So this is one chart pattern I have tried to explain here, and although I have never tried charting all these years, I think I'm starting to see some benefits of that, and over the next few months I would seriously want to understand the technicalities of it. If there is any course you have attended and if it has genuinely helped you, then do let me know in the comments box below. The final big section of the book focuses on when an investor should consider selling a stock. Now, according to William O'Neill, the secret to winning big in the stock market is not to be right all the time, but when you get it wrong, it is to lose the least amount of money. To put it in numbers, and as a strategy, O'Neill encourages investors to cut their losses if the stock declines by 7 to 8% from your buying price, and there should be no exception to this. In fact, the book goes a step further and features not one, not two, not three, but 9 different selling scenarios. So let's quickly run through those. The first signal comes from distribution days, and as we discussed earlier, if you're seeing a 0.2% drop on multiple days with increasing volume, then it's probably wise to be a bit cautious. Number 2, we have stock splits, and if the stock is up by 25% or more within 2 weeks of the stock split, then it's usually an excessive gain and it's time to pull the plug. The third scenario relates to technical analysis, and if a stock cuts through its upper channel line after a considerable run up, then the stock can be usually sold. The next scenario comes when a stock reaches new all-time highs, but the volume has dried up, making it a selling opportunity. Then there are situations where a stock exhibits poor relative strength, and we discussed that earlier in the video. So if the RS is poor, then it's a sign of weakness. Point 6 is when a stock is a lone ranger, which means it is the only one that is still advancing while the rest of the industry group is either constant or is actually declining. Of course, this means either this company has eliminated the competition or the industry group as a whole is facing a tough time. The next selling scenario is when a stock closes the trading day at the day's lowest price. If this happens on many continuous days, then definitely watch out and be careful. Okay, so I've lost count. I think it's point 8 now, which is a fundamental point, and that's a slowdown in the earnings of the company. If the slowdown, and I'm not saying negative, I mean a decrease in the earnings growth. So if the slowdown happens for 2 consecutive quarters or more, then there is a fundamental reason to sell the stock. And finally, there is a thumb rule that says if a stock falls by 12 to 15% from its peak, then it's probably a good idea to sell that stock or at least review that position. So these were the 9 reasons to sell that were listed in the book, How to Make Money in Stocks. And the guiding principle is very simple. That is, just like it's important to buy stocks at the opportune time, it's also crucial that you sell them at the right time. Alright, so we covered some major sections of the book in this video. There is of course the CANSLIM test, and before buying any stock, it's in your interest to know if it passes through the 7 rules or not. We then looked at charting and especially at the cup with handle pattern, which is one of William O'Neill's favorites. We also built the realization that one must face reality when you're wrong and should be ready to limit one's losses. And lastly, we looked at multiple situations, 9 of them, on when one should realize their stock gains, that is, sell their positions. Personally, the more I researched for this video, the more convinced I became of what O'Neill is saying and explaining. I urge all of you to get a copy of this book and do like this video if you found it useful. Also share this video with your friends, and I'll see you very soon on yet another insightful video. Until then.